There's a number, just 3 digits, that follows you your entire adult life. You probably know what it is. You might even be a little obsessed with it. It can feel like a grade for how you're doing at being a grown-up. A high score opens doors to apartments, car loans, and mortgages. A low one can slam them shut. But here's the thing we rarely stop to think about. This number doesn't just measure if you pay your bills. In the US alone, nearly 92% of insurers use credit-based scores to set your premiums for car and home insurance. Some employers check a version of your credit history before hiring you. It can even determine the size of the deposit you need to get a new cell phone. So here's the paradox. How did this one single number, a number that doesn't know your salary, your savings, or your character, become the silent gatekeeper to the most important milestones of our lives? If it's meant to be an objective measure of risk, why does it feel so mysterious, and for so many, so fundamentally unfair? Before this 3-digit score existed, credit was personal. It was local. If you wanted a loan to buy a house or start a business, you went to your local bank manager. He likely knew your family, where you worked, and your reputation around town. Lending was a judgment of character, but this system had 2 massive problems. First, it couldn't scale. As America became more mobile after World War II, people moved to cities where nobody knew their name. A banker in Chicago had no idea if a newcomer from Oklahoma was reliable. The second problem was far more toxic. It was deeply biased. This character lending was often a smokescreen for discrimination. If you were a woman, a person of color, or an immigrant, your character was often judged as inherently risky, regardless of your financial situation. The system was based on a handshake, but only if you were the right kind of person to shake hands with. The world needed a new system, one that was fast, scalable, and most importantly, impersonal. It needed to replace the biased gut feeling of a loan officer with the cold, hard logic of math. Enter the algorithm. In 1956, an engineer named Bill Fair and a mathematician named Earl Isaac founded a company you might have heard of, FICO. Their revolutionary idea was that they could use statistical analysis of past borrower data to predict future behavior. They could create a universal standard for risk. It took decades to perfect, but by the late 1980s, the FICO score became the industry standard. So, what is this secret formula? While the exact weighting is a trade secret, it's based on 5 key ingredients. First, and most important at 35%, is payment history. It's the simplest part. Do you pay your bills on time? A single late payment can have a big impact. Think of it as the foundation of your entire financial reputation. Next, at 30%, is amounts owed, or what's often called credit utilization. This isn't just about how much debt you have. It's about how much of your available credit you're using. Imagine your credit limit is a bucket. Lenders get nervous when they see it constantly filled to the brim. Keeping your utilization low, experts say below 30%, shows you're not over-reliant on debt to live. Third, at 15%, is length of credit history. The longer you've responsibly managed credit, the more data there is to prove you're a safe bet. This is why financial advisors say never to close your oldest credit card. Fourth, at 10%, is credit mix. Lenders like to see that you can handle different types of debt, like a mortgage, a car loan, and a credit card. It's like a financial resume. It shows you have diverse experience. And finally, the last 10% is new credit. If you apply for 5 new credit cards in a month, you look desperate. Each application can cause a small, temporary dip in your score. This was the breakthrough. A system that didn't care about your race, gender, or last name. It only cared about your data. In theory, it was the perfect unbiased solution. But a score is meaningless without data. The FICO algorithm is the brain, but the whole system needs a nervous system to function. That's where the three giant credit bureaus come in: Experian, Equifax, and TransUnion. These are private, for-profit companies that act as vast libraries of our financial lives. Your banks, your credit card companies, your mortgage lenders, they all report your payment behavior to these bureaus. The bureaus compile it into your credit report, and a scoring model like FICO or its competitor, VantageScore, analyzes that report to generate your score. Of course, this created a new problem. What if the data was wrong? In the early days, mistakes were common and nearly impossible to fix. This led to landmark legislation like the Fair Credit Reporting Act of 1970, which gave consumers the right to view their own reports and dispute inaccuracies. It was a crucial check on the power of this new ecosystem. But this ecosystem also had an unintended consequence. It changed our behavior. We started making financial decisions not just for our well-being, but for the score. We keep old credit cards open. We worry about the utilization ratio. We've all learned to perform for the algorithm. The system designed to predict our behavior began to dictate it. Now, you might think this obsession with a single score is universal, but it's not. The American credit system is, well, very American. It's built on a foundation of consumerism, encouraging the use of debt as a tool for economic mobility. But other countries do it very differently. Take Germany. Their system, called the Schufa, operates more on a no news is good news principle. It primarily tracks negative events, like late payments or defaults. If you pay your bills and don't get into trouble, your Schufa score is fine. There's far less emphasis on actively building a credit history by taking on different types of debt. The culture values stability over leveraged growth. And then there's the more controversial example, China's social credit system. While still evolving, the goal is much broader than financial risk. It incorporates a huge range of behaviors, from your bill payments to your traffic violations, and even your social media conduct. It's a system where financial trustworthiness is explicitly blended with social and political conformity. This global comparison reveals a crucial truth. A credit score isn't just math. It's a reflection of a country's values. Is the goal to expand access to credit, to maintain stability, or to enforce social order? Back in the US, the system is far from perfect. The great irony of a system designed to replace bias is that it can still perpetuate it. The algorithm may be neutral, but the data it feeds on is not. Because the traditional score relies on debt, it often fails to see millions of people who are financially responsible but don't use traditional credit. These are the credit invisible. They pay their rent and utility bills on time every month, but none of that typically counts towards their score. This creates a catch-22. You can't get credit without a credit history, and you can't build a credit history without getting credit. This is where the future gets complicated. Tech companies are pushing to use alternative data to solve this. Things like rental history, bank account data, and even your education level could be used to create a more holistic picture. But this opens a Pandora's box of questions. On one hand, it could help millions of people access credit for the first time. On the other, it could lead to a new, more opaque form of digital redlining. If an AI-powered algorithm denies you a loan based on thousands of data points, how could you ever know why? How do you regulate a black box? The ongoing debate is this. In our quest to measure trustworthiness, how much of our lives should we be willing to put under the microscope? The credit score began as a radical solution to a very human problem. It replaced the biased judgment of a loan officer with the impartiality of an algorithm. It built a system that allowed our modern, mobile economy to thrive. But in solving one problem, it created a new set of challenges. We now live under the quiet authority of a 3-digit number, a code that shapes our biggest decisions, influences our behavior, and reflects a society's deep-seated values and biases back at us. It has become a proxy for responsibility, a simplification of our complex financial lives into a single, digestible grade. And perhaps the most important question for the future isn't simply, how can I improve my score, but rather, what is this score truly measuring about me? And what essential parts of my story is it missing entirely?